Disney stock analysis, Q1 2022 earnings, Buffett's biggest mistake. The stake Warren Buffett recently acquired in Snowflake has more than doubled in value. His experience with Walt Disney offers valuable lessons. Welcome back to Investor Secrets. Today we're going to talk all about Disney stock and Warren Buffett's biggest mistake. So let's get right into it. One of the most famous pieces of advice offered by Warren Buffett is to only invest in what you know. This philosophy has tended to result in the Oracle of Omaha favoring asset-heavy firms and eschewing tech stocks. Additionally, Buffett's Berkshire Hathaway has tended to avoid participating in initial public offerings. It came as a surprise earlier this month when reports said Berkshire would participate in the tech IPO of cloud data warehousing startup Snowflake. Berkshire ended up acquiring $250 million worth of Snowflake shares. The investing conglomerate bought another 4.04 million shares at the debut price of $120. The total amount Berkshire spent on the IPO amounted to slightly over $730 million. The stock closed Friday at $240 per share, a 100% gain. In an era where tech stocks are considered to be overpriced and a severe market correction expected, it would be tempting to exit when the going is still good. The Oracle of Omaha has severely emphasized the importance of patience in investing. One of his favorite quotes says, "The stock market is a device for transferring money from the impatient to the patient." While Buffett's long-term investing credentials are not in doubt, it would not be out of character to exit the investment prematurely. He did this over 5 decades ago with Walt Disney. Warren Buffett leaves the House of Mouse too soon. Selling Walt Disney stock too soon is considered one of Warren Buffett's biggest mistakes. In 1966, Berkshire Hathaway bought a 5% stake in Disney at $4 million. Buffett sold the stake a year later for about $6.2 million. If Buffett were still holding the Disney stake today, it would now be worth $11.6 billion. This would give the investing conglomerate a paper profit of over $11 billion on top of dividends. While there's no guarantee that Snowflake will be a better investment than Walt Disney over the long run, its performance so far suggests bright prospects. What attracted Buffett to Snowflake? One of the reasons Snowflake soared after listing publicly is its fast revenue growth. During the fiscal year that ended in January, Snowflake registered year-over-year revenue growth of 133%. Revenue growth over the previous fiscal year was 174%. Over the past 12 months, Snowflake has more than doubled the number of customers to 3,117 from 1,547. With the value of the addressable market expected to grow by 50% between 2020 and 2023, Snowflake's revenue growth should continue, especially as it expands its global footprint. Still in the loss-making territory, but even though Snowflake is still making losses, those declines are narrowing as revenues continue to balloon. Another plus for Snowflake is that its cloud data warehousing services appear to be sticky. In the fiscal year ending in January, the net revenue retention rate was 169%. In the previous fiscal year, the net revenue retention rate was 180%. During the most recent 6-month period that ended in July, the net revenue retention rate was equally impressive, rising by over 150%. All these factors suggest a bright future for Snowflake, which boosts the stock's upward potential. While Warren Buffett has not always followed his advice, with Snowflake, he can't afford to repeat Walt Disney's mistake. Buffett worked out that the market value of the company was less than the value of its theme parks, which made the stock a traditional value investment. He bought 5% and then sold it a year later for a 50% profit. Buffett would own Disney again in the mid-90s when the company acquired one of his favorite companies, Capital Cities ABC. The $19 billion cash and stock deal left Buffett's investment firm holding 21 million shares of Disney stock. By the end of 2000, Buffett had sold all of Berkshire Hathaway's Disney stock. The reason why he did this isn't clear. There's been some speculation that the Oracle of Omaha was upset with Disney's executive compensation policies. According to my calculations, if Buffett had held on to the 5% Disney stake he acquired in the late 90s, it would be worth just over $13 billion today. The decision to sell Disney was not the only missed opportunity mistake Buffett has made over the years. In the early 2000s, the Oracle of Omaha also made a similar mistake with Walmart. Here's how he explained this trade at the 2004 Berkshire annual meeting of shareholders. It cost us about $10 billion. I set out to buy 100 million shares of Walmart, pre-split, at about $23. And Charlie said it didn't sound like the worst idea ever come up with, which is, from him, it was just ungodly praise. And then we bought a little, and then it moved up a little bit. And I thought, well, maybe it will come back. Who knows what I thought. I mean, only my psychiatrist can tell me. And that thumb-sucking reluctance to pay a little more, the current cost is in the area of $10 billion. Today, that 1 million share position would be worth around $12 billion, and that's excluding dividends received over the past 2 decades. The total return is substantially higher. Walmart has produced a total annual return for shareholders of 7.5% since the beginning of 2004. It might seem pointless going back and looking at these missed opportunities, but as Charlie Munger, Trade's Portfolio, said in 2004, it's essential to look at these mistakes and learn from them, as overlooking them would only compound the error. At least we're constantly thinking about the past occasions when we blew opportunities. Since those don't hit financial reports, the opportunities you had but didn't accept, most people don't bother thinking about them very much. At least that's a mistake we don't make. We rub our noses in our mistakes in blowing opportunities, as we just did. We can learn a lot from these mistakes as well. For example, with regards to Disney, we can learn from Buffett's error that it pays to hold on to high-quality companies that have a durable competitive advantage for the long term, as these businesses are highly likely to outperform the market. Concerning the Walmart mistake, I think the primary takeaway from this scenario is that sometimes it's better to pay up for quality if you think an idea is deeply undervalued, rather than sit back and try and wait for the perfect price. If you believe that the stock is trading at a substantial discount to its intrinsic value, paying an extra 5% is not going to derail your investment thesis. The lessons we can learn from Warren's loss. When I study stories like this, it reminds me, 1. No matter how smart you are, you're going to make mistakes. Accept it. Have a sense of humor about it. 2. If you keep your batting average good and avoid wipeout risk, it still works out in the end, in most cases, provided you live long enough. 3. Sometimes a quick profit can be a big long-term loss. There are only a handful of businesses in the world that are truly exceptional due to competitive advantages that are hard to replicate and difficult to destroy. If you get your hands on one at a decent price, hold on for dear life, through bubbles and bursts, booms and busts, and everything in between. 4. Everyone is aware of at least a couple of these exceptional businesses and often will do nothing about it for as long as they live. They'll spend their whole life knowing what they need to know to build a fortune and never lift a finger to make it happen. There's a disconnect between the knowing and the doing.